All right, welcome back to Is the Bottom In? I'm Dave, and today we're tackling a household name that's seen some serious turbulence lately, Kimberly-Clark, ticker KMB. This consumer giant, usually a beacon of stability, has taken a hefty hit, leaving many wondering, what the heck happened? Is this just a temporary blip, or is there more brewing under the surface? Let's dive deep and figure it out. So, what's been shaking KMB to its core? Well, the big news hitting the wires, and subsequently the stock price, is Kimberly-Clark's proposed acquisition of Kenvue. Now, on the surface, merging with a consumer health powerhouse like Kenvue sounds like a smart strategic move, right? But the market's reaction has been anything but positive. Investors are really spooked by two main things: potential shareholder dilution, given that it's a cash and stock deal, and, more importantly, the significant legal liabilities Kenvue carries, especially those lingering lawsuits around Tylenol and talc cancer claims. It's led to a sharp stock decline, and the overall sentiment is pretty negative, as if KMB is biting off more than it can chew. Before we get too deep into the drama, let's remember who Kimberly-Clark is. These are the folks behind the products we use every single day, from Huggies diapers to Kotex feminine care and Kleenex tissues to Scott paper towels. They've got three main segments: personal care, consumer tissue, and KC Professional. They sell to supermarkets, mass merchandisers, and even directly to businesses. This isn't some fly-by-night startup, it's a well-established global player with a strong stable of brands. Historically, they're known for consistent, if not explosive, growth and shareholder returns. So, this recent drop is definitely out of character for such a consumer staple giant. Now, here's where we pull back the curtain and look at the numbers. The market's reaction seems to be heavily discounting KMB's underlying operational strengths. Before the Kenvue news, KMB was actually doing quite well. Consistent volume and mix-led growth, expanding operating margins, and beating earnings estimates. But the Kenvue acquisition has completely overshadowed that, turning a healthy operational trajectory into a high-risk situation in the market's eyes. It's a classic case of fear trumping fundamentals. Let's break down our scenarios. First up, our base case, which we're assigning a 35% probability. Here, we're assuming the market's initial negative reaction is a bit of an overreaction. While dilution and legal risks are real, Kenvue's strong brands could offer long-term strategic value. Management has a solid track record, and the legal stuff, while concerning, might not be as catastrophic as feared. We're looking at KMB's current EPS of $5.90, assuming a modest one-year forward EPS growth rate of 3.5%, balancing performance with uncertainty, giving us a projected forward EPS of around $6.11. Then, applying a PE multiple of 18x, which is a bit above current depressed levels but below historical highs due to ongoing uncertainty, we get a fair value of roughly $109.92. The technical downtrend is concerning, preventing a higher probability, but we believe strong fundamentals could provide some stabilization. Next, the bull case, which, frankly, looks a bit more challenging in the near term, so we're only giving it a 20% probability. For this to play out, the Kenvue acquisition would need to be a home run, highly synergistic, accretive, with legal liabilities contained and minimal financial impact. Integration would have to be smoother than anticipated, leading to significant cost savings and revenue growth. We'd see a re-rating of KMB stock as investors recognize the long-term value. With a current EPS of $5.90, we'd assume a more optimistic one-year forward EPS growth rate of 5%, pushing our projected forward EPS to about $6.20. Apply a PE multiple of 20x, reflecting enhanced growth, and our fair value jumps to around $123.90. Now, why only 20%? Because the current technicals, with KMB in a clear downtrend and significant resistance at $125, make this outcome pretty tough without a major positive catalyst. Finally, the bear case, which, given the current market climate and technicals, we're assigning the highest probability at 45%. In this scenario, the market's worst fears about Kenvue are realized. Significant legal liabilities from Tylenol or talc claims lead to massive financial penalties and reputational damage. Integration challenges are substantial, resulting in cost overruns and a failure to achieve synergies, disrupting KMB's core operations. Shareholder dilution and increased debt levels weigh heavily on per-share metrics, and the market assigns a persistently lower valuation multiple due to heightened risk. Starting with that same 590 EPS, we'd see a stagnant 0% growth rate due to these issues, keeping our projected forward EPS at 590. Then, applying a much lower PE multiple of 16x, reflecting the increased risk and uncertainty, our fair value drops to $94.40. And why the higher probability? Because the technical analysis strongly supports this. The stock is in a clear downtrend, it's gapped down, and it looks like it's heading for lower support levels, signaling continued market skepticism and selling pressure. All right, let's pull up the chart and see what the technicals are screaming at us. From what I'm seeing, KMB is in a clear downtrend, no two ways about it. We've seen it gapped down to around 105, which is a pretty significant move. The next major support level we're watching, folks, is all the way down at 88. So, if this downward momentum continues, that's where the next battleground could be. Now, for KMB to even think about resuming an uptrend, it needs to decisively maintain above 125. Until then, the path of least resistance, unfortunately, looks to be to the downside. The chart is definitely painting a cautious, if not outright bearish picture. So, is the bottom in for Kimberly-Clark? Based on our analysis, and especially with that high probability bear case and the bearish technicals, I'm leaning towards no, not yet. The market is seriously concerned about the Kenvue acquisition's legal and financial repercussions, and the chart confirms that sentiment. While KMB has strong fundamentals in its core business, the acquisition-related risks are dominating the narrative and driving the price down. I'd say there's more pain to come before we see a true turnaround. Given our scenario analysis, particularly the bear case fair value of $94.40 and the technical support at 88, those are the levels that would start to pique my interest for a potential long-term entry. The base case fair value around 110 might represent where it should be, but the market isn't there yet. I'd be looking for signs of stabilization or a bounce around that $88 technical support level before even considering dipping my toes in. All right, that's our deep dive into KMB. What do you think? Do you agree with my take? Let me know in the comments below. If you found this analysis helpful, smash that like button, subscribe to the channel if you haven't already, and hit the notification bell so you don't miss our next episode. Now, for the important stuff. Remember, I am not a financial advisor. This is for educational and entertainment purposes only. Investing in the stock market involves risk, and you could lose money. Always do your own research, consult with a qualified financial professional, and never invest more than you can afford to lose. This is just one man's opinion on whether the bottom is in. Your mileage may vary. Stay safe out there, and I'll see you next time.